Hello and welcome everyone. This is Benham from Banks and Markets. In this video, I want to continue the debate about investment in stocks in 2023. Can there be some good money-making opportunities through investment in stocks? Now, in the previous video, we were motivated by the fact that some wealthy investors are claiming that in 2023 there will be a major stock market crash. So we argued that perhaps we can implement some strategy, some simple such as buy low when the stock indices are towards the bottom and then buy the stocks. So buy low, and when the stock indices start rallying upwards again, sell the stocks. Can we implement such a simple strategy and make some money in the year 2023? Now in this video, I will quickly talk about the type of portfolio we formed. So in our portfolio of stocks, we said we will take blue chip stocks, the stocks which are fairly large in terms of the market capitalization, and they are established companies. Generally speaking, they are also the companies which are among the top 3 in the sector. And they are also companies which are generally speaking giving good amount of dividends. So we, based on that simple criteria, what we did, we just went to some website and searched the richest companies in the world, and that gave us so many companies, and from that we just took 30 richest companies in the world, and we found these as the top richest companies. Now, in this example, I'm taking data from 2017 till 2020, 5 years data from 17 till 2020, because if I take the start period, something like March 2020, which is here, it's obvious I'm going to make my money double within less than a year time. So I don't want to repeat that example here. So what I've done, without any kind of influence, I'm just taking randomly 5-year data point from 2017 till 2020. I just want to see if this strategy will work, in which I will just be investing in some blue chip companies. Now, the major motivation here to provide you this illustration is also to teach you a number of risk-adjusted return, and other tools that will help you gauge, assess how the portfolio performed. Now, these learning objectives can be very useful to those of you who are also preparing for professional body exams such as the CFA, CIPM, because what I'm going to say to you is going to be very useful when you need to compute the risk and return, or risk adjusted return, so many other indicators related to portfolio performance evaluation. So without losing more time, let us begin, which basically means first thing I would like to say to you is I formed the portfolio of 30 stocks. They are from 7 different sectors, 30 of them, and then I found their returns, because these data related to share price adjusted for dividend can be easily obtained from different sources such as Yahoo Finance, and then I also have data related to one of the indices, Dow Jones Industrial Average, here as an example, and I find the returns, and I also made the case that the investor will have just $1,000 to invest at the start of January 2017. So $1,000 for Apple, when value-weighted strategy were applied, would mean 8.5% investment in Apple. So 1,000 times 8.5% is going to give us $85. And that's what we have here for investment at the start in Apple, and so on for different companies. In total, of course, there will be just this 1,000, which is what we see as the portfolio value. Let me just expand it and you will see this 1,000. After that, we just leave the investment, which means we are assuming that the investor is kind of lazy person, not because he's not interested to work, but because the person has a lot of other commitments. So although the person is making the investment themselves, i.e. do it yourself, the person is busy just making use of a trading platform, but then do not frequently changes the weight of investment, i.e. there's no rebalancing. So you just leave the portfolio as it is. So the way it changes the value in the market, we will just leave the portfolio as the value in the market changes. So no more monitoring required. So now with that kind of passive investment strategy, you will see that the value of the portfolio, which is at the start was 1,000, is after 5 years is 2,435. This is for the portfolio, which I now have highlighted in yellow. That's portfolio. Now on the other side, I have the benchmark value, which is something I'm able to compute very easily because I find out the benchmark return, and benchmark values were also downloaded here. So 2890 divided by 19864 minus 1 is what I had done to get this 5.17% or so, which I have here. So basically benchmark return has been computed. Portfolio return is just the difference in the portfolio values, take away 1. So now that I've got portfolio return and benchmark return, I now want to show you different measures of return and risk, how they can be used to evaluate the portfolio performance against the benchmark. So there are different indicators. The first one that I have is called the geometric mean. Now, geometric mean is very popular among investors, fund managers. When you have periodic value of the portfolio, different values, and different period, geometric mean is more commonly used, whereas arithmetic mean also gives you some indication of the return, but this is more of an indicator of how the portfolio return would look like in the future. So this arithmetic mean is more of future. So ex ante is arithmetic mean ex ante, whereas geometric mean is going to be more of ex post, which means how did the portfolio performed. So to find this one out, you just need to do equal product 1 plus all the rate of returns. This is what you will do. But after that, this is for different periods. So how many periods you have? 60 different months. 1 over 60, take away 1. Okay, that gives you geometric mean monthly. In order to analyze it, what you can do is in a year, there are 12 months, and therefore you can simply power 12 take away 1 is what you can do. So that's annualized geometric mean, and that's something we have found. So another thing we can quickly find is the average return, which is basically the summation of all the returns divided by the numbers of those. So that's all the addition of the return divided by 60 is what going to give you the monthly return, which is 1.59%. Alternatively, you can simply do average, open bracket, all of that taken, 1.59 is again there. Now, in order to analyze again, same as before, 1 plus periodic rate of return divided by number of period, 12 months in a year, take away 1. So after this, what you can do, put it for the index and put it for the index as well, so that you can now compare how your portfolio performed against the benchmark. So you now have the outperformance. So you see outperformance is almost 5%. So your portfolio has performed superior, 5% point superior okay, in terms of geometric mean. And the same thing in terms of arithmetic mean is again superior for your portfolio performance. So the portfolio has, in terms of return, performed way better as compared to the benchmark, and this is something we have been able to see when we computed the arithmetic mean as well as geometric mean. Of course, it's true that in a context such as this, geometric mean is a better indicator. Now, in terms of formula, this is what is happening with the arithmetic mean and geometric mean. This is the formula we used to compute the geometric mean. So arithmetic mean, very simple. Add all the returns, divide by number of returns. Geometric mean, again simple, but what you need to do is find the product of all the returns by keeping 1 plus return 1 times 1 plus return 2 times 1 plus return 3 times all the way to 1 plus return n power 1 over n take away 1. That gave you the geometric mean. This third thing here called compound annual growth rate, but it is exactly the geometric mean. Here you can make use of the values. So here the portfolio value toward the end was this at the end, and portfolio value at the start was 1000, which is here, and this was for 5 years. So 1 over 5 take away 1 is what you can do. You can see the result is exactly same. The formula here is basically this one, which is compound annual growth rate, value now, value beginning, 1 over n, the number of years, take away 1. So that's compound annual growth rate, and this is something you can do also for your benchmark. If you have the value of the benchmark indices, which I have here, 1977. I mean, this is the value I have made by considering the fact that at the start it was 1000, and power again 1 over 5 take away 1, so that gives us exactly the same, 19.5, 14.6, 19.5, 14.6. So basically this formula here for geometric mean is doing the exactly same work. Now if you were to be working out this, if you were to work out this rather quickly, you could have done something like product 1 plus all your periodic rate of return power 12 months in a year divided by 60 take away 1. You would still get the same value, which is, and instead of doing 1 over 60, then again in the second step 1 plus r power 12 take away 1, you can also do it in a one single computation such as this, and the same for the index. Okay, so that's what you have been able to find. But many investors, they are keen to know, when am I going to double my investment? So number of years taken to double the investment amount. Okay, so that's something you can do simply by doing this, which is double means 2, so log of 2 divided by log of your rate of return, which is 1 plus this your geometric mean annualized. So that's almost 20%, so this should be about 4 years. So 3.89 years is what it is going to take to double. Now, what is it in case of the index? In case of index, of course, it is going to be higher. So more than 5 years it will take to double your investment. So say different ways of evaluating the return performance of the index. Now, in terms of risk, what is popular is the standard deviation. Okay. Of course, it is just the square root of the variance, but standard deviation is more commonly used. That's what I'm going to show you next, which is equal stdev dot s, because it's for sample. Take all the data period, return data period, you get this, which is now monthly. To annualize, you just take the same times is square root number of months in a year, 12. That gives you the annualized standard deviation. So that's what you are getting for your portfolio has 30 companies, and the index also has somehow similar number of companies. We see in terms of the risk performance, your portfolio has again outperformed the benchmark, because here lower the better. So here therefore portfolio minus the index standard deviation, so your portfolio is lower, so this is better. So this is what we have been able to see in terms of the risk. Now I have a number of other indicators, and these are simply, simple mathematics that you can quickly compute using Microsoft Excel. So you may be interested to find out some statistics, such as what was the highest monthly return. So you can simply do equal max and highlight all the portfolio return data period returns, and you get the maximum. So in that 5-year period, the maximum monthly return was 12.41%. So you may then say, what was the lowest return? So of course, maybe there were some months in which the returns were negative. So negative 8.48%. Now cumulative return is basically the total. Okay, so total return. So here you can simply sum them all up. So 95.39%. So this is basically to say, if you were to add all these returns, so that's something I can simply show you here, or I can keep this computation here somewhere. Okay, so that's let's say 1 equal this times 1 plus the rate of return of your portfolio, which is portfolio return 3.71%. So that's what you get, and you start to bring it down all the way until your 60th month, which is here. And now you can in fact draw the line. So this is a cumulative return thing, also known as the equity curve. Now I pushed it slightly on this side so that it can look like something upward rising, which it is to a large extent. Of course, there is a dip here, and this thing that we have made based on the cumulative return data is basically called the equity curve. So this is equity curve, and we found for the equity curve the number was, and that 95 is basically, if you wanted to compute, you can simply take the portfolio return, start adding up with this return, and you'll see that it is going to give you same graph. Of course, this way you'll find that 95 thing at the end, which is 95.39. So again, that is to say how £1 will grow. This is just the accumulation of all the return. Okay, anyway, the curve which represents the cumulative return is called the equity curve, and a smooth upward rising equity curve is a good indicator of the portfolio performance, which to a large extent is correct for our portfolio. So that's what we've been able to find in terms of cumulative return. Now, number of up period is here, which is basically to say how many times our portfolio won. So you will win if your return is positive. So you can say equal count if the portfolio here, all of that was greater than, in these, how many of those are greater than 0? This is what you want to find out. So it's saying out of 60 periods, 45 periods you have up period. So of course then you know already that the number of down period would be 15, but to find it out you just need to change the sign, and that's what you get. Now here we want to think something in terms of probability. So probability of up period. Now based on what happened historically, what is the probability of up period? So probability of off period is number of off period divided by total number of periods, which is 60. So that's going to give you that 75%. Probability of down period 15 divided by that total, which is 60, 25%. So that's how you add up to 100%. Now average gain during up period is another good way to assess how the portfolio performed during a bullish market period. So for that, what you can do is you can apply average if function, average if, open bracket. So you will simply do equal average if, open bracket. You will give the range where from you want to find out that return. So you've given the range, and then your criteria is again greater than 0, and again you need to assign the average range, and that's it. That is going to give you average gain during up periods. Now if you are doing this for the first time, then what you can think is you want to find out the average when the returns are greater than 0, isn't it? So you can do something like equal sum if, then take all the return, okay, sum if, and the criteria again can be greater than 0 and portfolio return again. So this time you're going to get the addition, the total of all those returns that are greater than 0, which is this number here, okay? Sum if means added. Now you just need to divide this by number of up period. That should give you 3.57%. That's 3.57, as you can see here, exactly 3.57%. So that's what is happening with average gain during up period. Okay, average loss during down period is basically the same, but you just change the sign to less than 0. That's negative 4.35%. Now this is a useful, very useful ratio, which is gain-loss ratio. If it is 1 to 1, then if it is 1, then basically it's like break even. But if it's higher, then you know that the portfolio is doing better. So gain divided by loss, isn't it? Average loss during down period is what you can do, and you can get gain-loss ratio of 82. So that's what you achieve here in terms of gain-loss ratio. I mean, another way of looking into this could be, you can simply say, in fact, you can also call it average return during up period, isn't it? So maybe it's better to make it like average return during down periods. Well, generally speaking, it's the same, but this shows you the gain-loss ratio, which here is 0.82. It's not 1 or greater than 1, but we cannot say just based on this the portfolio performed poorly, because you can see here probability of period is 75%. So now let's look into this probabilistic market condition related return. So in order to do this, what you need to do is probability of the up market, or probability that the market will be bullish, 75%, times what is the rate of return during such up market, 3.57, plus probability that the market will be bad, 25%. What is the rate of return? 4.35%. Now this is going to give you that probabilistic return, which is 1.6%. So that's good in a way that you've been able to find out the return under different probabilistic market condition. Similarly, you can also find out the risk. Now, firstly, you can see this return, which is 1.6%, and see here 1.59%. This is exactly same, in fact, what you have computed. If you expand this, 1.590 is what you will see in your arithmetic mean return. Okay, so that's exactly same. Don't forget that. Next, you have risk under different probabilistic market conditions. For this, you can do square root, because standard deviation formula has the square root x minus x bar, where we're talking about x, and this x, before the x you need the probability, which is 75%, times now x minus x bar is 3.57 minus the x bar, which is this number here, square. So now x minus x bar is squared, close bracket is what you have done, and again plus you need the bear market probability, so that is 25%, times your y, which is average return during down market period. Take away your average return, which is going to remain the same, is square is what you need to do, close bracket. And now this square root is here for all of these, so basically you may want to impose brackets in both places. So this is what you get as risk under this probabilistic assumption of 75 and 25%. So it then basically means everything what you have done here can also be done easily and quickly for the index. So this is what you will achieve. So gain loss ratio 0.82, which is superior as compared to that of index, and return wise probabilistic, again better for the portfolio as compared to the index. Maximum monthly return also superior. So basically this outperformance can be computed here just by taking the differences. You can see negative return is lower as compared to that of index, so again in that respect as well the portfolio has performed better. Cumulative return is also superior. So number of up period for the index, 2 number of days higher than that of the index. Again, number of down period 2 days lower in terms of negative, and so on. So a lot of these can be computed in fact in the same way. Okay, so that's outperformance, but these all are very simple evaluation using some actual function. You may not find them in the textbook, but something to realize in the context of how the portfolio performed based on some simple math. But now we want to focus more on the tools that are more common when it comes to portfolio performance evaluation. But this is something I'm going to discuss in the next video. So in the next video, I'll be talking to you about the composite risk-adjusted return techniques such as SARP, Trainer, Jensen, Information, and other tools that are either complementing or supplementing these ratios, and few more. So thank you very much for your time, and thank you very much for listening.